Hello and welcome to the credit training, what funders are looking for in a CBR session. My name is Monica Harper. I'm the Executive Director of the AACFB, and I want to welcome you to today's presentation. Please note that this session is being recorded, so all participant lines will be muted during the broadcast. However, you can submit a question at any time during today's presentation by using the chat box. The recording of this presentation will be available on demand later today on the session page. Our presenter today is Brad Kohlauer. Brad is the Vice President of Credit and Syndication for Equipment Leasing Group of America. Prior to joining ELGA, Brad spent over 20 years in commercial banking with positions in relationship management and portfolio management in the Chicagoland area. He managed customers with needs from SBA lending all the way to mid-corp banking. Brad, thank you for sharing your expertise today. It's all yours.
Thank you, Monica, and welcome everyone, and look forward to giving you some information on credit bureau reports. I look at them, seems like every single day, and what I'd like to do is just run through a couple of them, give you some indication of what I look for on these and some aspects of how you can help funders in their goal as far as reviewing a credit bureau report and maybe answering some of the questions that they have prior to submitting them to a funder. So I'm going to share my screen. We're going to run through two credit bureau reports that I have, and I blocked out the social security numbers and some of the personal identification information on this, but it should be some information that hopefully you guys find informational. So here we go. So the credit bureau reports, really everyone knows there's three of them. It's the Equifax, TransUnion, Experian. Those are the three main ones. And from what I've gathered, the scores should be theoretically the same across all three of them. The difference is, from what's been told to me, is that it's really comes down to the timing. And some of them update their information daily. Some of them might update the information weekly or bi-weekly. And so depending on when the information comes in, that really accounts for the differences in the scores if you were to pull all three at one time. The aspects of these credit bureau reports now is really, the formatting has been much better than in the past when I used to look at these. And they give you a lot more of a snapshot information to really make quick decisions and quick inquiries as far as what's important. The ones that we use is Equifax, and so I'm going to go through Equifax and really just kind of highlight the boxes, what I look for, and what you might grasp from this as well. First thing I do is really just check the name, the address, date of birth, and the social security number, and check that against the application if you're filling out an application, and making sure that they match. And one of these aspects that you can see here in this consumer information is a PO box number, which is kind of a little bit of red flag that it doesn't have an address. And so you'd really need to dig in there to see why this is in there, where they truly live, and make sure that that matches the application. Another aspect of this address here is really, and we can get down a little bit farther, but showing how many times the applicants moved and showing the stability of the applicant, and are they a homeowner? Are they a renter? Obviously, homeowners show more stability. They're not going to pick up and move right away. And if they are a renter, typically you want to see somewhere where they have lived in the apartment or their condo or the townhouse for more than 3 years. And that shows some stability. And if they don't have that, then maybe they're moving around town within the same city, and that's an aspect of that as well. The alerts and triggers here, I really haven't gotten much out of this. This is really, they call it the fraud ID scan. There's things that might pop up there that you want to address, but I really don't put a lot of credence into what comes out of this because I just haven't understood what the credit bureaus put into there. Another aspect that I like looking at is how old this date of this file was established. Here it was 1985, and then I'll measure that against the date of the person's date of birth. And really you want to have the date of the file established somewhere in their mid-20s, gives you an idea that they have that. If it's not, then they might have immigrated to the US later and established in the file, but you really want to kind of get an idea of when that's established. And also you'll see exactly when the first credit was established as well. And if it's a difference between established being 1985, but their latest credit or their most recent credit was, let's say, 2007, there's a gap there. And you just need to understand why there was a gap there. And there might have been a bankruptcy or something in the past that isn't being reflected, but it's just one of those things that I kind of look at and want to make sure that there's a full history dating going back to when the file was established. Equifax kind of gives you this account overview. And so it's a quick summary of where their credit is lying. And the first thing you notice is that they have a mortgage. So that gives you some indication of stability as far as home goes, that they have a mortgage. It's important from the aspect of a credit risk. Obviously, it's been proven that people that have mortgages typically are better credit rating. So that's one aspect of it. These other things then, the revolving and installment shows, pretty much a pie chart of where it is, a percentage. I don't take too much credence in the number here itself until I get a little bit farther down into the credit report. The summary over here is important as well. It shows the aspect of where their credit is divided between revolving, installment, and mortgages. I don't see too many line of credit or others, but this tells me that they have about 17 trade lines, 18 trade lines, which is a good number. Again, here's the aspect of 19 years, their length of credit. The average age is about 8 years, so they've had a little bit more recent credit is what it tells me. You want to check the occupation here, make sure that it matches, and if it doesn't match, you ask why. Find out a little bit more. Maybe it's just a recent job change or something along those lines. That's good to know as well. The almighty credit number here, the 690, this tells us what the score is. And really, from my point of view, couldn't tell you the difference between a 660, a 690, and a 720 as far as how the credit bureaus determine that. All of them put in these metrics down here. Typically, the one that's at the top is probably the most meaningful. But the things I've seen, you'll look at an 800 credit score, they'll have the same verbiage as a one with a 500 credit score. They just put something out there. So I don't take a lot of credence in what they're showing here. And again, the 690 is if there is used in a lot of automatic credit scoring models. They'll take that, put it in, that's their number. Typically, I like to look at it and see as a starting point and then go from there, making some judgments as far as looking at the overall credit and understanding where that's coming from. And if there's something out there that could change my mind if I dig a little deeper. Down here, you're gonna get the recent bankruptcy if there is one. You can inquire about that, try to get more information, what caused it. Obviously, all those questions you could ask the applicant will help then from the funder standpoint that you've dug in a little bit and tried to understand the applicant's credit history. Now I go over here and this is kind of a spot that I'll look at as well, is the 30-day, 60-day, 90-day. And this person obviously has some late pays, some delinquencies, but then again, this doesn't tell me a whole lot until I get down further into the report and see where they actually lie and understand where they're coming from. Are they coming from a student loan? Are they coming from some sort of medical bill that hasn't been paid? Something that tells me what type of credit it's tied to is important. From a student loan standpoint, maybe they didn't have a job right out of college and weren't able to pay their bills. Well, if that's what it is, now they're current on their student loans, that goes a long way towards me understanding that that credit risk has been mitigated. And they might have a lower score, but I understand that aspect of it. And this is just kind of a rehash of that. Going down here, this is kind of shows a little bit more now as far as the trade summary and the account status. Shows me that there's 2 mortgages, there's 1 with balances. Revolving, there's 8 accounts, 3 with balances, 7 with 2 balances. The part that we look here now is really the ratio of revolving. And one of the big decision points that a lot of the funders look at is the total balance here, the 25,000 versus the total credit limit down here of 50,000. And one of the aspects that's probably driving down the score a little bit is that that's about 50%. And typically funders, I think, like to have it below 25%. So 50%, you're kind of at that limit. Anything above 50%, what it indicates is that there's not a lot of room for them to go and access credit on their own from, it's really tight. And so if they needed cash advance off their cards or something else, there's an emergency, they don't have that ability to go and get additional credit, and they're already fully loaded. And so that really would drive down the score. If this thing showed 45,000 up here, your credit score would be much, much lower. Now down here, this kind of, again, highlights where those delinquencies were coming from. 2 is from the mortgage, which most likely would be a concern that you hope that your mortgage would be one of the first thing you pay. And then over here, then again, the 323 indicates that it came from some sort of revolving credit. So I keep going down and we get into the actual accounts now, the individual accounts. And from here, I look at it, there's nothing outstanding on the 2000. Here's their mortgage. This is an updated mortgage. There is nothing else, there's no lates here. So I'm a little bit more at ease that their current mortgage that they have outstanding doesn't show those lates. The American Express card, typically the American Express card, it gets paid off monthly, but they have a large balance against it. You might inquire, if they do pay it off monthly, but and it's their only, that's about half their credit they had outstanding. There's no lates against that. But what I want to do is try to dig down into here and try to find out where those, there's some auto loans here that are being paid. I want to find out where those lates are coming from. And here I find it. So the 323, so it comes from one account. It's the Capital One account. And this one was opened in 2003. Nothing here shows it within the last 3 years. So it's something that inquire about, but it's not a driver. I understand where it's coming. And then looking at the next one, it's about the same time as the other one closed. Well, they actually gave them, a $25,000 card. So Capital One wasn't too concerned. So I get some comfort from that as well. So those are the things that I'm looking at to try to mitigate a score and truly understand where that person's credit history lies and understand that story. I'm going to go to the next one here.
This is a hard pull or a soft pull?
This is a soft pull, and we typically do soft pulls. Some some places will do hard pulls, and then that will actually show up as a credit inquiry. Soft pulls do not, are not supposed to show up as a credit inquiry. And so you can always ask who the funder is, whether they pull a hard or a soft pull. And depending on who they take to, that will affect your credit score. If you have numerous ones over a short period of time, that will drive down your credit score as well. But there is one aspect here that, I mean, go to the next credit report now. Just want to touch one last thing here. This is the other home mortgage. Again, there was nothing late here in the last 3 years, is two, so I don't put a lot of credence into that, those 2 30-day lates. So this next one, and I wanted to touch on here, and I know we're running up against time, but so this person is fairly new, right? Their date of birth is 91, so they're about 30 years old. Credit was established 4 years ago, so they're about 25 years old, so that makes sense. Oldest open accounts 4 years ago as well. This person has a 586 credit score, which I just don't understand why it's that low. But then again, here's the reason: the ratio of balance to limit on bank revolving or revolver is too high, and I'll show you why. But you know, he's got a revolving of $7,500, $75,000 for installments. It'll show that it's 2 car payments. He likes nice cars. 2 30-day delinquencies, which isn't terrible. That shouldn't be a reason for 586. So then we get down here, and then this shows why. So now this person has 6 revolving accounts. He's got 6 with balances outstanding, and his total balance to his credit limits about 75%. And that's the reason it's really driving down his credit score. So now you could say, how could I help this applicant? Because a 586 credit score is going to kick out a lot of funders. They're just not going to happen. But digging in, because this customer we actually financed, he had a good paynet score. He had, you know, probably about $30,000 in the bank. He had a good reference. So I'm trying to understand then his CBR and what's going on. Hasn't moved around, so he's been in Indianapolis the whole time. Here's a credit inquiries. Again, we didn't touch on this in the other credit bureau, but you can kind of see he's got a lot of credit inquiries. Well, a lot of them stem from buying a car. You can kind of see that: Acura, Gap One Auto, Ally Financial. So even though he's out there buying a car and it shouldn't impact it, it has, most likely. But you take those out, not a lot. There's one in 2021, and that was kind of it. So again, you're kind of going, what's happening? And I just want to get in here. So here he went out, and I think he's trying to establish credit is what my guess is. And that he's got Best Buy. It's a $2,000 card, but he's got $1,500 on it. Capital One, $250, but $174. Again, Cap One. So what if he would have taken some of his money and paid off some of these cards, because it's not a huge balance, his score would probably be in the mid to upper 600s. So by digging in and understanding that, and here's his, you know, one of the 30-day lates was in April, which is kind of when COVID hit, and a lot of the truckers, you know, there wasn't a lot of activity going on. I kind of discount that as well. So it's the aspect of trying to understand what's driving the score lower, trying to get those questions answered. You could sit there and say, if you pay off some of your small balances and pay this down to where you're at about 30% of your ratio of outstanding to your credit limit, I could probably get you a better rate, and you're going to get more funders actually interested in that credit. But there's other, for this customer, for this applicant, we were able to get comfortable with his low credit score by understanding some of these aspects, and also the mitigating parts of their overall picture. So hopefully that gives you some indication. Again, it's a short 20 minutes, but if there's any questions, I'd be more than happy to answer them at this point.
We did have a few questions. One of them, what is the reason that an underwriter prefers a hard pull over a soft pull? And is there different information on the report?
From what I hear, there isn't any different information. It's just, it shows up, and technically, I think it has to do with a government regulation where banks need to do more hard pulls because they have to then tell the government that they did a pull on this, they check their credit, and if they turn you down, then they have to go and let you know why they turned you down. So from my understanding, that's one of the driving causes, is if a funder is under the regulation of the FDIC or some aspect of that, that they have to do more hard pulls than companies that aren't regulated like us, that we can get away with a soft pull.
So the information is not going to be different.
No,
Okay.
no, they show the same stuff.
They want to know, are you using a service or are you pulling this directly from Equifax?
We are set up with Equifax, and so we are pulling this directly from Equifax.
Okay. I will say that we do have a couple of discount programs within the for AACFB members. So if anybody's interested with that, let me know and I can help you find that information. And those are all the questions that I see right now. Oh, there's a question, can we do soft pulls through the discount program with AACFB? And the answer is yes. I know that with our Core Logic program, you do need to let them know that you want to get set up with soft pulls, because I think there's a different switch or something they have to turn on to allow that, but it is an option.
Very good.
And then there's a comment that unless you are a home-based business and then only hard pulls. Some of the, so I can't remember which one, but there are different credit bureaus have different stipulations as far as whether you can pull if you are a home-based business or if you are if you own your home. So you just have to look and see what their stipulation is, because some will let you pull if you own your home, but others won't let you pull if you're working out of your home. So,
right.
And I can't remember which one's which, but I know that's the case. I think that's all of the questions that we have. So with that, we'll wrap it up. Thank you, Brad, for your time today and your expertise. Don't forget, everyone, to visit your exhibitors today between the hours of 4 and 5 Eastern time to have live video chats. And please join us on the next presentation. It's back to back today.
All right. Thank you.
Thank
Bye,
you.
everyone.
Have a great day.